everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. Thanks for joining me on a Monday night here. Going to, for the two things that grabbed me recently, or two things that grabbed my attention recently, I guess. Going to jump right in as per usual. First off, U.S. December retail sales were the biggest month-over-month drop since 2009. Falling 1.2%, and as we've noted over and over and over, at 155, I thought this was a really important data point because at 155% of GDP, the U.S. stock market effectively is the U.S. economy, primarily through the consumption link. When you look at net capital gains plus taxable IRA distributions are about 200% of annual growth in personal consumption expenditures, and so if capital gains are rising and or if markets are rising, you're adding to consumption, notably through both the capital gains side as well as the taxable IRA side. None of that 200% includes the impact of restricted stock or stock options, which are all taxed as ordinary income according to the IRS. So the bottom line is I thought it was very interesting that in a December where we had the worst December in 87 years, we had a big negative surprise on retail sales. I don't think those two things are coincidental. The other thing that highlighted this is federal tax receipts declined 0.4% in 2018. First full calendar year under the new tax law, despite robust economic growth, despite record low unemployment. And to me, this highlights again the importance of asset prices in driving GDP growth and driving tax receipts and driving consumption. And to me, it points to a need, it puts more pressure on the Fed ultimately to do something about that. And it speaks to why, to the chagrin of many, that the Fed's really unspoken third mandate at this point are rising asset prices. The second thing that really grabbed my attention recently has been the EU calling together industry in the EU to work on, quote, tackling dollar dominance in the energy trade. And it was interesting, they noted that the EU is the world's largest energy importer on an aggregate basis. Their annual energy import bill is about 300 billion euros a year over the last 5 years on average. But 85% of that is paid in dollars, not euros. And so this is another indication that that we're seeing global energy markets move towards a more multilateral, multi-currency system, which is ultimately, I think, a very big gear in driving a lot of the dynamics we've seen in energy markets, in FX markets, and in rates markets over the last several years. So I'm going to leave it at that. I'm going to open it up for some questions if anybody has any at this point. Again, and as always, if you want to see what we're up to, check out FFTT-LLC.com in terms of the latest of what we're up to. And so let me see if there's any questions here. I'll wait for a couple minutes to see what comes up. Hopefully everyone had a very nice President's Day holiday. Let's see. So far, no questions. Usually it takes a couple of seconds to pop up through to my feed, so apologize for the delay. Let me see. And France is looking to create a non-dollar option to buy Iranian oil without sanctions. Yes, France, Germany, the UK. There's been discussions to work through with a special purpose vehicle to do that. You also saw the Saudi finance minister 2 or 3 weeks ago talk about potentially that there are talk about considering funding or borrowing money in euros, which would obviously speak to a likelihood that they would sell oil in euros as well, potentially. And so you're continuing to see the inertia behind this multi-currency oil pricing and settlement seems to continue to build momentum. Let's see. Hi, Zach. Do you see a Yuan depreciation in the near future with their big stimulus in January? One thing I've been watching closely has been the tie between physical gold flows and what the yuan does. Goldman Sachs had a piece out on Bloomberg a little over 2 years ago noting that every time the yuan fell against the dollar, gold flows left London and went east into China. That dynamic has continued. And so it was interesting as the yuan fell against the dollar from, call it, April through October of last year. You saw large amounts of gold siphoned out of London, out of the GLD, which is warehoused in London. And it all, generally speaking, went east. And interestingly, pretty much the moment the yuan stopped falling against the dollar in, call it, mid to late October of last year, so did the gold flows. And so gold flows reversed and began flowing back to London. So I bring this all up as one of the things I'm watching as it relates to yuan depreciation with some of the big stimulus is that if the yuan does fall, I continue to think those looking for a very big break of critical numbers, whether that's 7 or even to 8 or 9 in the yuan, I don't think people watching the yuan dollar are paying enough attention to physical gold flows and how those physical gold flows increasingly appear to be acting as a governor. Always not that big a threat. We're still going to use it. We're not going to let the Americans tell us what to do. We'll see if that continues, but to me, when taken together with a number of other things, it seems like there is a bit, I won't go all the way to call it a jailbreak yet, but there is a groundswell or an increasing quorum of foreign countries that appear to be disregarding what the U.S. Foreign policy establishment has to say, which is particularly countries that used to basically blindly listen to us no matter what aren't doing so anymore, which I think there's some interesting potential informational value there that I am watching. Hi Wyatt, is there a currency you think is a safer haven than the dollar? Swiss franc. I've not looked at the Swiss franc a whole lot. I do think it would, I mean, historically it has had very much a safe haven bid, particularly, it used to be, well, up until 2000 or 2002, something like that. It had a portion of, had very large gold reserves relative to the currency outstanding, which, of course, made it both that and sort of its historical safe haven, added to this historical safe haven status. I suspect there's still some element of truth to that given, last I saw relative fiscal discipline there. But ultimately, I think if you have a big risk off, the dollar still, I think the one currency that does better than the dollar is gold. It's, to me, that's less a currency as much as than it is a monetary asset. So let me see here. Any comments on China bond defaults? Hi, Tony. No, not really. I mean, not to be flip, but thus far they are still, relatively small in terms of the aggregate size. I continue to, find fascinating the degree to which the United States is starting to talk about MMT or modern monetary theory in terms of financing deficit spending. As a good thing when we see China running something quite similar, and it's a bad thing, which is about par for the course these days. Everything the U.S. does in the U.S. media is good. Everything that China does in the U.S. media is bad, and the truth is probably somewhere between those two, somewhere, shades of gray. And so, if a Chinese, if a state-owned Chinese bank makes a loan to a state-owned Chinese company, the state-owned Chinese company defaults to the state-owned Chinese bank, is there a loss? And not really technically. Now, ultimately, this has implications for the currency, but this then it should manifest itself in a weaker yuan over time. But again, this ties back to the point I made earlier about yuan and gold, which is to say, it appears every time the yuan gets close to 7, London gets drained of a whole lot of gold, and if it were to break through 7 and move on to 8 or 9, like some more high-profile yuan bears think it could, the bleed of gold, if pattern of the last several years holds, the loss of physical gold out of London would be epic. So much so that I think you could come into a force majeure situation. And so that to me is the wild card in this that I just think very few people are watching. In theory, gold tonnage and the price of gold should have nothing to do with Yuan dollar movements, but for the last 2.5 to 3 years, they've moved very closely together. Not a lot of people are paying attention to that yet. Let me see. Hi, Wyatt. You're welcome. I appreciate you buying it and reading it. It was fun to do, and like I said, we're working on volume 2 as we speak. And so now that I've committed to that publicly, I'm going to have to. I'll make sure to follow up and make sure it gets taken care of. Let me see. Hi, Jason. How significant do I think time decay is in leveraged ETFs? I'm in JNUG Bigley, by the way. I'm the JNUG you have to remind me, is that the triple leveraged long gold ETF? If that is correct, the time decay on these things is big, and I would just, to me, I think they're attractive vehicles for short-term speculation, but the time decay you're talking about for leverage ETFs makes them not great for longer-term core positions. So just be aware of that. Let me see. Any good reason to hold commodities and gold versus only gold? It's a very good question. Look, to me, we're in the late innings of a global sovereign debt bubble, and they only happen once every 80 to 100 years. And when they burst, gold wins against everything else. And so I think you got to own some gold. The timing of it though is tricky, and of course this is the first cycle where sovereign debt cycle where we have had these monumentally leveraged paper gold markets overlaying the physical markets, and so there's some things that are you have to make adjustments for. I won't say they're different this time, but you have to make adjustments for. I think so. I think you want to own some gold, but I think the commodity side, when you look at the valuation of commodities relative to the valuation of paper assets, then I do think that you look at relative valuation levels being at near 100-year lows, and I think that there's a case to be made there over the course of the next X years that commodities should do fairly well. So that's, I guess, how I would answer that. Is the gold ETF? Hi, Ragmus. Is gold ETF acceptable versus physical gold? Under most scenarios, probably. Under certain scenarios, maybe not. Look, if you read the GLD prospectus, there is force majeure type language there where it says if we can't get gold, we can cash settle you, is effectively what it says. In other words, in extremis, you do run the risk. If you hold GLD, you run the risk of, some sort of, if there's a binary revaluation of gold over a weekend, gold goes out at 1,300 on a Friday and reopens Sunday night at 3,000. It is entirely conceivable. I'm not a lawyer, so I would not take this to the bank. But the language is force majeure type, boilerplate legal language that, to me, introduces the risk in my eyes. Again, I would have a lawyer look at it. It introduces the risk in my eyes of you being able to be cash settled at prior close. And if that's the case, you'd hate to own gold, be right, and have your ETF say, whoops, you get 1,300 in cash, and sorry about your luck. And the reason I bring this up is I once owned an oil ETF. It was I think it was a double long oil ETF. The ticker was DXO back in 2009, and I bought it in, I think, April or May of 2009, and it was doing great. It was a decent-sized position. This is just personally for me. And in September, for whatever reason, the sponsor of it said, whoops, we're closing this thing out in 10 days, and that's it. And even though the underlying was right, even though oil had moved higher, I still ended up losing money on the trade because once the sponsor of the ETF said, we're not doing this anymore, we're closing this thing down, it just turned into a fire sale, and that was it wasn't a catastrophic lesson, but it certainly wasn't a cheap lesson to have learned. And so, to me, that's always gotten my attention. Any preference between GLD and SGOL? I don't know SGOL. I know the Sprott guys, and to me, for institutions, the Sprott gold ETF is less liquid than the GLD, and so it's generally not as well institutionally owned. But the language in the prospectus of the Sprott, which I think is the PHYS, is the ticker on that one. The language is, and I haven't looked at the language in it in probably 3 or 4 years, but the last time I looked at the language in it, look, you could convert and get a 400-ounce bar if you own 400 ounces worth of PHYS, which is not available for GLD unless you owned 100,000 shares of GLD, or call it about $12.5 million at current prices. So. Let's see. Yes, no counterparty risk. Exactly right in terms of physical gold. That's exactly the benefit of that. And so let me see. Any other questions tonight? If not, I'm going to jump off here. And looks like that's about it for tonight. So hey everybody, thank you very much for jumping on. And we'll be back on Sunday night, normal time, 7 p.m. New York time. And I will certainly tweet about that. On Sunday afternoon. Otherwise, everyone have a great night. Good luck this week, and we'll talk to you all soon. Take care.